Welcome, ladies and gentlemen, to Lesson 8, Inventory Costing and Cost of Goods Sold. Before you watch this lesson, please make sure that you've watched Lessons 2, 3, and 4. Lessons 2, 3, and 4 cover some key concepts that we want to carry forward into this lesson. So, things like journal entries, T accounts. You want to make sure you understand those concepts before you get into this one. So, that being said, let's move on and get into some inventory concepts and definitions, and then we'll move on to some problems. Alright, so inventory includes goods that are held for sale in the normal course of business or used to produce goods for sale. So if you go back to Lesson 1, you'll remember at the bottom of one of the cheat sheets, so front or back, the bottom of the cheat sheet you had those operating activities for different types of companies: service, merchandising, manufacturing. Okay, the manufacturing company bought raw materials and then made goods with those raw materials. So this is just saying, inventory includes those raw materials and also the finished goods, similar to the finished goods that a merchandiser would have, where they bought the finished goods itself, or whether you manufacture those finished goods. Alright, so that's what inventory includes. Let's get into some inventory cost. Well, and then we can also discuss the types of inventory or tracking inventory. These concepts, tracking inventory, isn't necessarily going to affect how we cost it and how we go through these problems, but the concepts to know, these are included in your flashcards. I'm going to read these just so you get the right definition. Go through your flashcards, memorize the concepts. They may appear on exam, they may appear in a test. Alright, perpetual inventory system. In the perpetual inventory system, the inventory record shows the number of units and cost of each type of merchandise stocked. The inventory record is updated every time an item is bought, sold, or returned. With the introduction of relatively low-cost computers, all companies use the perpetual system. Perpetual system, anybody uses that. Everybody uses that. Nobody uses a periodic. But back in the old days, there was a difference. Some people did a periodic, or they did a full wall-to-wall count. Well, let's describe the periodic system. All right, periodic inventory system. Rather than updating the inventory record each time an item is sold, bought, or returned, the periodic system updates the inventory record at the end of each accounting period. A physical count of inventory is used to update the inventory record. Now, remember back to Lesson 4, we did a closing entry where we said, supplies, we did a count of supplies, and at the end we found that there was $500, but we started out with $800, and so that $300 difference we recorded to expense. Well, that's kind of like a periodic system where you say, I know what I had at the beginning, so I'm going to count what I have at the end, and that difference, well, it must have been used, so that's the expense. Not very many companies use that anymore. More companies use the perpetual system, with the advent of computers, scan guns, all types of inventory systems, or computer systems that have enhanced the inventory tracking system, and that's why most companies use the perpetual. All right, so we're going to move on for those type of tracking systems and get into the costing. Costing. There's 4 generally accepted costing methods. The first one is specific identification. The second one is first in, first out, or FIFO. Last in, first out, or LIFO is the third, and then weighted average is the fourth. Specific identification is just that. You specifically identify the cost of an inventory. This is generally used for large pieces of equipment, like special orders. Like an airplane, it takes so many parts, it takes so much time. You specifically identify the cost of that specific unit, and that's that. You say, this is the cost, this is how much it took, and there's no averaging or anything like that. First in, first out. Oldest costs go to costs of goods sold. Recent costs go to end of inventory. That may not make sense. We're going to go through a problem, and hopefully it makes sense afterwards. LIFO. Recent costs go to cost of goods sold. Oldest costs go to end of inventory. It's kind of the opposite of FIFO. If that doesn't make sense, we're going to go through a problem. Hopefully it makes sense afterwards. If not, just rewatch the lesson and go through the concepts again. All right, weighted average. When a unit is sold, the average cost of each unit in inventory is assigned to cost of goods sold. So there's an equation for cost of goods sold. Weighted average cost of goods sold. It's the cost of goods available for sale divided by the number of units on hand. That's the average cost per unit. And you'll see, this will make more sense when we go through problems. Advantages of each method. Well, weighted average, as you say, if you're averaging everything, it kind of smooths out the cost, right? So weighted average smooths out price changes. First in, first out. Ending inventory approximates the current replacement value because your first in is your first out. So the thing you last received, well, that's going to be in your ending inventory. So that the advantage of first in, first out is that your ending inventory approximate replacement value. Okay, so last in, first out, it better matches current costs and costs of goods sold. With revenues. Okay, so what that says, since it's last in, first out, the last item we bought is the first one out. So cost of goods sold matches the price of the last item we bought. So that's why it's saying it better matches revenues with expenses. Generally, people use FIFO or weighted average. Not too often do you see LIFO or specific identification, but that doesn't matter because in your practice exams and homework, you're going to see all four of them just because that's how accounting works. All right, reporting inventory at the lower of cost or market. The value of inventory can fall below its recorded cost for two reasons. It's easily replaced by identical goods at a lower cost. It becomes outdated or obsolete. So the concept is inventory needs to be stated at the lower of cost or market. Inventory needs to be at is either replacement value or what you can currently sell it at. Sometimes inventory will fall below that. So say, I don't know, like right now, General Motors just declared bankruptcy. There's a lot of General Motors cars out there that aren't being bought. So with that excess demand, the price goes down, and so you need to mark your inventory down to what you can save it at. You know, when there's this excess supply, the demand isn't there, your prices go down, and so you need to adjust your inventory costing. Hopefully that'll make more sense once we go through the problems. Okay, so this is how this cheat sheet's set up, and this is how probably most of your homework or your exams are going to be set up. You're going to be given a set of inventory purchases or revenue transactions sales, and then you're going to need to go walk through each of the different types of inventory costing and calculate how the different types of costing give you a different ending inventory and a different cost of goods sold. So we're going to go through those. First off, we're going to start with specific identification. You'll see the data set or the information in the first part of the cheat sheet doesn't necessarily apply because specific identification, well, we specifically tell you what that cost of the inventory was. It's pretty straightforward. We sold this inventory for $100, and that was what it cost. Well, let's go through. So 3.1, Round Belly purchased 10 life vests with a per unit cost of 100. So you see that 10 units cost 100, total 1,000. 10 units, $100 cost, 1,000. So we got $1,000 of inventory of 10 units. That's what we have on hand in specific identification. March 1st, right? Going to B. On March 3rd, Round Belly purchased 15 life vests with a per unit cost of 110. All right, so we say that inventory is going to cost 110. 15 units times 110 is $1,650. All right, so you see how this works. As we purchase inventory, that's going to end in our ending inventory balance column. As we sell and we get to the next one, the cost of goods sold is going to go through this middle column. C. March 14th, Round Belly sold 20 life vests with a per unit selling price of $220. All right, we sell, with a per unit selling price. Okay, so that's our selling price. That's our revenue. Okay, what's the cost of the goods sold? Well, you have to be given that. So on March 14th, you see down below here, on March 14th, Round Belly sold 8 life vests, originally costing $100, and 12 life vests originally costing $110. So that's our cost of goods sold. 8 units at $100, $800. 12 units at $110, $1,320. You have to be given the specific cost in a specific identification problem. That's down here below in the asterisk. All right, moving on. D, in the specific identification. March 17th, Round Belly purchased 20 life vests with a per unit cost of $120. See that? 20 units, $120, $2,400. That flows over to our ending inventory balance. E, Round Belly purchased 10 life vests with a per unit cost of $127. Here, E, 10, 127, $1,270. Okay, so we're summing across here. This column, we're taking out cost of goods sold in our ending inventory balance right here. We're subtracting out cost of goods sold and we come up with our ending inventory. Now F, on March 31st, Round Belly sold 23 life vests with a per unit selling price of $230. Okay. That's the per unit selling price. What's the cost? We have to be given the cost in a specific identification problem. That's down below here. The cost of the items sold on March 31st were as follows. 2 units at 100, 3 units at 110, 15 units at 120, 3 units at 127. And you'll see those delineated here in the cost of goods sold. We calculate that, subtract it from our ending inventory balance here, and we end up, our ending inventory balance and cost of goods sold is $1,489. The ending the cost of goods sold is just a column as the sum of this column, which you'll see down here. Specific identification cost of goods sold is $4,831. All right. Now, that was specific identification. As I said, when you sell something, you have to be given the specific cost of that